If we could start, please. Good afternoon and welcome. For those of you who don't know me, my name is Bernard Schneider. Among other things, I'm the academic director of the Institute of Tax Law. And it's in that capacity that it's my honor and privilege to welcome Mr. Malcolm Gammie, CBE KC, to the Institute and CCLS today. Mr. Gammie is one of the leading advocates of the revenue bar, began as a solicitor, worked in KPMG, or I guess the predecessor of KPMG and Linklaters, was a very distinguished practitioner before deciding, I guess, that wasn't enough, and became, was called to the bar in 1997, took silk in 5 years, which is probably a record, and has had a distinguished career as a barrister ever since. Equally importantly, particularly in the context of this talk and this venue, Mr. Gammie has been very active on many fronts in tax policy. He was president of the CIOT and is currently on the academic board of the Addington, right, which you've heard of, is chair of the Tax Law Rewrite Commission at the IFS, the Institute of Fiscal Studies, also has very long involvement there, was on the Mirrorless Committee. I could go on, but I won't, I promise. Has also published widely in respected well-known journals, including the British Tax Review, Intertax, and many other places. So it's really, and I'm not doing Mr. Gammie justice, but in the interest of hearing from Mr. Gammie, which is the important thing, it really is our honor and privilege to have Mr. Gammie here today to talk about an area he knows so well and has contributed to so much. So on that note, if you would please.
Thank you.
Thank you.
Well, it's very kind of you to introduce me in that way. So this is not going to be a precisely timed lecture this afternoon, but I can assure you I'm not planning to go on until 5 o'clock. So you'll be pleased, I'm sure you'll be pleased about that. The catalyst for my choice of subject today was the Supreme Court's decision in a case called NCL Investments last year, and I'll come to that in due course, but on the assumption that not all of you will be perhaps as familiar as I am with the tax law rewrite, I want just to go over a little bit of history to explain where we are so that we're all on the same page. Now, as Bernard said, I've over many years been involved with the Institute for Fiscal Studies, going back actually to the 1970s. I have in my time been chair of the executive committee and things like that with the IFS, and as you mentioned, one of the editors of the Merleys Review. But the particular bit of IFS work with which I was involved with the tax law rewrite was the Tax Law Review Committee, which was set up in 1994, and I was its research director for very many years. I'm still a member of the committee, and in fact, I was chairman for a period, but I gave that up a couple of years ago, and Professor Judith Friedman is actually now the current chairman of the Tax Law Review Committee. Anyway, the IFS set up the Tax Law Review Committee in 1994, particularly because of its sort of ongoing dissatisfaction with the state of tax law in the United Kingdom. And one of its first projects that it undertook was a project on tax legislation. In other words, to look at whether or not tax legislation couldn't be simplified in some way. I should say that over the course of my time, both for the IFS, but also the Institute of Tax and many other bodies, the Law Society and the like, I've probably been involved in more simplification exercises than I've had hot dinners, but you might think that things don't get any simpler. Indeed, I spent some time over the last week trying to finalize some advice on a particular area of the tax law, where even after a good deal of time thinking about it, I'm still quite perplexed as to what the legislation actually means. It's one of those areas of rewrite tax law where subsequently people did things that the revenue didn't necessarily think was the right thing, so they legislated, which made it all a great deal more complicated And at the same time, they said they didn't really need to legislate because they were pretty sure that what people were doing wasn't permitted under the existing legislation, but nevertheless, they added a whole series of new provisions, which it's almost impossible to work out exactly what the policy or purpose was of them. Anyway, that's by the by. I'm not going to talk specifically about that, but it was one of those further exercises in trying to get some order and simplicity, or greater simplicity, clarity to our tax legislation, that the Tax Law Review Committee started work in sort of 1994-95, and we benefited very significantly in those days because the Inland Revenue seconded a very bright young man by the name of Chris Davidson, whose name pops up in a variety of other contexts in subsequent years, both with the revenue and outside the revenue, to work as one of the research staff for the Tax Law Review Committee. And I worked closely with him on that particular project. And at the same time, the Finance Act 1995, I think, is due to a sort of backbench revolt by the then Conservative MPs, put in a section 160, which required the Inland Revenue to prepare and present to ministers a report on tax simplification. That project was called the Tax Simplification Project at the beginning. If you go back and look at the various consultative papers that were produced at that time, they're called Tax Simplification, but of course it ultimately came to be known as the Tax Law Rewrite. And the Tax Law Review Committee work and the Revenues work, when I say proceeded in tandem, looking through the sort of timetable of what was happening, the Tax Law Review Committee produced an interim report on tax legislation in November 1995, and the Inland Revenue report, called The Path to Tax Simplification, was published in December 1995. The final report by the Tax Law Review Committee was published in June 1996, and the Inland Revenue's consultative document, called Tax Law Rewrite, The Way Forward, was published in July 1996. So there was a sort of general momentum then building up towards the tax law rewrite, even though at the time it was frequently called tax simplification. But one of the issues about that, rewriting tax law, was how you dealt with the parliamentary procedure, because of course tax bills need or follow a particular procedure in Parliament, but more to the point, if they are formal tax bills, they open up all manner of different possibilities for amending the law, which any government would probably not want to offer to members of Parliament. So the Tax Law Review Committee actually established a working party to look at the parliamentary procedures for the enactment of rewritten tax law, and that produced a report in November 1996. There's a copy of it. And in fact, that was also followed by a report by the House of Commons Select Committee on Procedure, which reported in January 1997 under the title Legislative Procedure for Tax Simplification. The Tax Law Review Committee Working Party was chaired by Geoffrey Howe, the former Chancellor, then Lord Howe, and included MPs from both Labour and Conservative. That was Clive Betts MP and Quentin Davis MP. Lord Brightman was a member of the Working Party, as also Lord Taverne, who had been the first director of the Institute for Fiscal Studies back in the 1970s, and Chris Davidson was its secretary. And I should just perhaps read you one of the sort of key points that it makes in relation to the tax law rewrite bills that were being proposed. In its introduction, it said this: it will not be possible to present a tax simplification bill to Parliament as a normal consolidation bill. Such bills must be certified not to change the law, but the substantial changes in language which this project is designed to achieve will mean that the risk of minor inadvertent changes in the effect of the legislation cannot be entirely excluded. Moreover, it's likely to introduce some deliberate, though limited, modifications in some areas. Therefore, it will not be possible to give the necessary certificate. Neither will it be realistically possible to apply the ordinary public bill procedure. There are two aspects to this. Firstly, the Inland Revenue estimates that there are 6,000 pages of primary direct tax legislation. The rewritten law is unlikely to be materially shorter and could be significantly longer. Well, we all know that was the result of the rewrite. Since the full project is expected to take around 5 years, in fact, it took more like 15, Parliament can be expected to receive several thousand pages of tax bills spread at the longest over 4 or 5 years. Using the ordinary bill procedure would require a prohibitively large time commitment from the normal legislative machinery and from MPs themselves. Secondly, it would be quite inappropriate to treat the rewritten legislation in the same way as ordinary public bills, including finance bills, since this could, and almost certainly would, reopen debate on tax policy issues, which had already been enacted and established. Consequently, what is needed is an intermediate, tailor-made procedure which will enable Parliament to scrutinise the rewritten legislation properly, but without opening up debate on policy matters which have already been approved by Parliament and which are not intended to change. Finding an appropriate parliamentary procedure for an enactment of the rewritten legislation is a crucially important prerequisite if the enterprise is to be efficiently and constitutionally completed. That is why the Tax Law Review Committee invited Lord Howe to establish this working party and why the government offered its support. Well, of course, it followed that there was a special procedure for the enactment of the rewrite bills involving joint committee of both houses of Parliament, and that was the way in which all the bills were enacted. I won't go more into the detail of that because we're more concerned, or I'm more concerned today with the results than necessarily the procedure, but obviously this background is important because it informs the basis upon which this legislation should be approached and considered when the courts have to come and decide what exactly it means. And I'll come on to that in due course. As I said, the actual process of enacting the rewrite bills took a great deal longer than the 4 or 5 years that was optimistically suggested in the TLRC's Working Party report. The first bill was the 2001 Capital Allowances Act, and that was followed by the 2003 Income Tax Earnings and Pensions Act, which we all call ITPA, then 2005, the Income Tax Trading and Other Income Act, which we all call ITOIA, and then the Income Tax Act 2007, which sort of cleared up most of the income tax, then the 2 Corporation Tax Acts of 2009 and 2010, and the income tax, the international tax provisions, TIOPA, Taxation, International and Other Provisions Act 2010, a sort of whole mass of legislation right at the end in 2009, 2010, at which point everybody collapsed with exhaustion at this amount of rewriting. There was a proposal at one stage that the Management Act should be rewritten, but that was abandoned. And it was also decided the idea of rewriting the Capital Gains Tax Act, the 1992 Act, was also abandoned, although, of course, more recently we have seen some of the chargeable gains provisions rewritten in the sort of more normal rewrite style. I'll come on to the style in a minute. It was a hugely demanding procedure. Before it actually got into Parliament, the revenue themselves went through what the initial director of the Tax Law Rewrite project, Neil Munro, for whom I'd actually worked back in the 1970s when I spent time at the Confederation of British Industry. He was my boss there on loan from the Revenue, but he, by that stage, became director of the tax law rewrite project within the Inland Revenue in the late 1990s, early 2000s. He wrote an article for the Inland Revenue's own internal journal outlining what this involved, and he said that there were 5 particular stages in the process that the Revenue were going through. The first was to research and analyse the existing legislation, see where it had come from, what it was designed to achieve, and of course some of those aspects of the legislation went back as far as well, I was going to say 1842 to Peel's Act, but of course Peel's Act was based on Addington's Act of 1803. So, and of course there were even some hints of Pitt's Act of 1798. So there was a very long history of these provisions, but of course a significant amount of amendment that had gone on over the couple of centuries that have been involved in the income tax. I won't go through the history, more of the history at this stage of the acts, but of course, large amounts of development over that particular period. So that was the first stage, and probably the longest and most demanding stage of the Inland Revenue's work. Having gone through that process of research and analysis, the Inland Revenue team would issue instructions to the drafting team, and there was a large rewrite drafting team. I haven't looked up to see just how large it was at its sort of largest point. I think there might have been as many as 15 drafters at some stages in the rewrite team, some on loan, of course, from the Parliamentary Council's office. So then that would be the second stage, producing instructions. Then, of course, there would be the drafting process, and then there would be consultation. The consultation comprised a consultative committee which was drawn from most of the sort of major representative organisations who were concerned with this. I represented the Law Society on the consultative committee. I think Graham Aronson represented the Bar. And of course, there were many others from the Chartered Accountants, Institute of Tax and the like. And then there was a steering committee, which was chaired by Lord Howe, which was supposed to sort of give its imprimatur the seal of approval that this was not changing the law except in minor identified ways. And then, of course, the legislation would be published for consultation before it was actually presented to Parliament through the special procedure. So a huge project that went on, as I say, between the late 1990s, well, 96, 97, through to 2010. You can see, just from that sort of brief outline, that in terms of the legislative output with which we've been dealing since the early 2000s, when the legislation started to emerge, that this was not consolidation, but at the same time, it was not a bill or an act that had gone through the formal finance bill procedure in Parliament, but it was new legislation rewritten with the intention of producing something that was clearer, more easily understood, had better signposting and the like, was not written in the sort of lawyer's language that only lawyers can understand. And it also, some of the acts included a specific ability to correct mistakes within a certain particular time by statutory instruments. So that's the animal with which we are dealing. Now, it obviously took a little while for some of this legislation to come before the courts. But in fact, I think the first case in which anything of substance was said about the tax law rewrite was one where I was representing the Inland Revenue, by that time, Her Majesty's Revenue and Customs, a case called Eclipse 35. which was one of these film scheme cases where I think it was an organization called Future Films had sold to a lot of punters the idea that if they signed up to invest in these particular films, it was a couple of Disney films involved in Eclipse 35, although as it was Eclipse number 35 LLP, as you'll gather, there were Eclipse LLPs up to number 40, I think it was, so quite a lot of them. And they invested in a variety of Disney films, including, I think, a couple of the Pirates of the Caribbean films, although the Eclipse 35 films were not the Pirates of the Caribbean films. And this was done in such a way that, broadly speaking, you know, you put your money in, hey ho, you've got a loss, and broadly speaking, nothing much else happened. Least of all, did you earn any money from it other than the tax that you got back? I paraphrase very significantly in relation to Eclipse 35, but that'll do, I think, for current purposes. And the issue in Eclipse 35, one of the major issues was this entity, Eclipse 35 LLP, actually carrying on a trade? And for the revenue, I argued that its activity did not amount to trade. Effectively, what it was doing was just putting up money, which then went round in a guaranteed financial circuit to make sure that people got, at the end of the day, got their money back, but hopefully got a good tax result in the interim period. And although theoretically there was a possibility that under these arrangements, if the films in which Disney films in which they'd invested did spectacularly well, they might get some money. The chances of that actually happening was pretty low. And in fact, the films involved in Eclipse 35 never came anywhere close to generating anything that might be described as a profit for the investors in the film. So the question was it trading? And as I say, I was arguing for the revenue that it wasn't trading, and the commissioners, the first tier tribunal that heard the case, concluded that it wasn't trading. But they suggested that it was probably carrying on a non-trade business. Now, this was rather an unusual thing, maybe, for the tribunal to have decided. But the basis of that decision, or at least how they arrived at that conclusion, was a provision of the Income Tax Trading and Other Income Act that was introduced by the tax law rewrite. It hadn't been there before. Of course, there were provisions under the previous legislation which recognized that film activity could amount to a business without necessarily being a trade. But there wasn't a specific separate head of charge in respect of a non-trade business. But there was one introduced under the rewrite, Section 609 of the 2005 Act. And I think it may well just have been a piece of paper that was circulated to the consultative committee. It probably was never actually published as such as part of the rewrite, but the basis for this new provision, as described in the rewrite, is described in a paper produced in July 2002 by the Revenue for the benefit of the consultative committee. And the proposal in this piece of paper, we propose to create a separate charge for non-trading income from films or sound recordings businesses, both United Kingdom and foreign sources. And it goes on to the analysis of existing law and reasons for proposal, the special deduction rules for films and sound recordings in sections 40A to 40D of the Finance No. 2 Act 1992 apply to both trades and businesses. We've rewritten these rules for trades they're in Part 2, Chapter 8, Bill 3, and need a separate charge for businesses where the activities fall short of a trade. There are at present no specific charging provisions for income from non-trade film and sound recording businesses. Such income is chargeable under Schedule D, Case 6 for United Kingdom sources and Schedule D, Case 5 for foreign sources. The new proposed charge will be carved out of a general charging provision and dealt with, together with special deductions rules, in a separate charging chapter. The new chapter will apply to both United Kingdom source and foreign source businesses following our integrated approach for foreign income. The creation of a new charging chapter for this income provide a convenient link with the special deductions rules for films and sound recording businesses where the activities fall short of trading, which might otherwise be missed. So that was the sort of underlying material that had been provided for the consultative committee, of course, as a sort of non-public piece of material, couldn't actually be relied upon in interpreting the legislation. But there, as a result, in the 2005 Act was a separate chapter and charge in respect of films and sound recording businesses which did not amount to a trade. Now, the argument for the taxpayer in the upper tribunal, once it got there, was that there was effectively no basis for a Case 6 charge in respect of this activity that Eclipse 35 had engaged in. In other words, it either had to be a trade, or if it wasn't a trade, it wasn't investment. There was sort of no halfway house between trade for what Eclipse 35 was doing and a sort of straightforward investment where you just buy a sort of share in a company or invest by lending money to an entity or something like that. So that threw up immediately the question as to whether or not the decision by the first tier tribunal was one that it could arrive at as a matter of law. In other words, could it really say that this was an activity that did not amount to a trade, but was nevertheless some sort of activity which amounted to a business? Counsel for the taxpayer in the upper tribunal, not at the first tier tribunal, was Graham Aronson. And I always remember he started his submissions in the upper tribunal with a lengthy exegesis of the tax law rewrite and how it wasn't supposed to change the existing law. And therefore, if you looked back to the old scheduler system, the various schedules, which of course the rewrite had done away with, it had created a new structure for the Act, which didn't rely upon schedules. But he said, if you look back to the old schedules, Schedule D, you can see that this activity must have been a trade. It could, the first tier tribunal couldn't conclude that it was an activity short of a trade. I have to say, he did not get a sympathetic response from Mr. Justice Sales, as he then was, in the upper tribunal. Mr. Justice Sales, in his decision, explained why he was not prepared to sign up to this. He said, I reject this part of Eclipse 35 submissions for three reasons. First, the general orientation in approaching the task of interpretation of Section 609, which is to be derived from consideration of the explanatory notes in accordance with a statement by Lord Steyne, is that this part of ITOIA was intended merely to consolidate existing statutory provisions in a more user-friendly format without changing their content or legal effect. That is, the explanatory notes indicate that this part of the ITOIA should be approached and interpreted in the same way as a Consolidation Act. The reference in paragraph 6 of the explanatory notes to the special truncated parliamentary processes used to enact the ITOIA reinforces this impression. Consolidation Acts are similarly enacted by use of special truncated parliamentary procedures. The law regarding the approach to construction of a consolidating statute was explained by the House of Lords in Farrell and Alexander and is well settled. When construing a consolidating statute, which is intended to operate as a coherent code or a scheme governing some subject matter, the principal inference as to the intention of Parliament is that it should be construed as a single integrated body of law without any need for reference back to the same provisions as they appeared in earlier legislative versions. An important part of the objective of a consolidating statute or a project like the tax law rewrite project is to gather disparate provisions into a single, easily accessible code. That objective would be undermined if, in order to interpret the consolidating legislation, there was a constant need to refer back to the previous disparate provisions and construe them. Therefore, the court's main task in this case must be to construe the Itoya without reference back to Section 18 of the 1988 Income and Corporation Taxes Act and Schedule D. However, where undertaking such an exercise, a provision which falls to be applied is found to be ambiguous, a subordinate presumption comes into play, namely that it is presumed that there was no intention to change the meaning of the provision, which has been repeated in the same language in the consolidated code. In such circumstances, it may be relevant to try to determine the meaning of the relevant provision by looking to see what it meant when it was previously enacted. But of course, what was absolutely true of virtually the whole of the rewrite legislation was that it was not repeated in the same language as that previously used in the Income and Corporation Taxes Act 1988 and other finance acts. As Mr. Justice Sales went on, in my view, there is no ambiguity in Section 609. It plainly contemplates that two types of case may exist and be subject to tax under the code set out in the Itoya, namely businesses involving the exploitation of films where the activities do amount to a trade, and businesses involving the exploitation of films where the activities do not amount to a trade. There's no warrant for referring back to Section 18 of the 1988 Act to assist in the interpretation of Section 609. The first-tier tribunal's interpretation of Section 609, paragraph 414, cannot be faulted. And then that's not me. Hang on a second. Silence my phone. My apologies for that. Your pause. Contemplate. As Justice Sales was saying. Anyway, he went on with two further reasons, effectively to say that even if you do go back to Section 18, he could see no reason why the scheme of Schedule D shouldn't allow for the possibility of a non-trade business under Schedule D Case 6, and his final view was effectively to support the submissions that I'd made, that there was no reason why one should. So that I think was the first comment in relation to the tax law rewrite legislation. This Justice Sales saying very much a similar approach to be adopted to that used for consolidation acts. In other words, you start off with the legislation in force or applicable in the particular year in question, and that's what you're trying to construe and work out what it means. And broadly speaking, it's only if you have a particular problem with that necessarily you might want to look back to the particular origins of the legislative provision. I'd have to say, and this is some of the point of talking about or thinking about this subject, when you have a set of provisions such as the income tax provisions and the corporation tax, of course, which in its historical origins derives from the income tax provisions as well, and they go back over a couple of hundred years, it seems a little bit, seems rather bold to sort of cut yourself off from the history of those provisions. And my own approach, and definitely my sort of inclination, is that one should always be aware of where a provision came from and what it was designed to do. Of course, that was a lot of the work that the Revenue was trying to do before it got to the drafting process for the tax law rewrite, to work out exactly what the origins of the legislation were and why it was there, what the policy was that it was aiming to achieve. And there are obviously other areas of law. I mean, one only has to think about the Supreme Court's approach, for example, in the UBS tax avoidance case, where it had to look at share incentive schemes, where it looks back at the history of those provisions to sort of determine what exactly, how exactly it should construe the legislation, which actually in UBS, I think I'm right in saying, was not part of the tax law rewrite, because it was one of those provisions under ITPA where ITPA introduced or rewrote all the existing share scheme legislation and it took effect on something like 6th of April 2003, only for it all to be completely thrown out and rewritten on about 15th of April 2003, when the government announced new provisions for dealing with share incentive schemes, but nevertheless the new provisions were still written supposedly in the rewrite style, and as a code they were an integrated code to be construed as they were enacted, but nevertheless in UBS, for example, the Supreme Court looks back to the development, the historical development of share schemes for deciding how to interpret the legislation that they're looking at. So it's clear that you don't completely cut yourself off from the past, but nevertheless, one can see the point that Mr. Justice Sales was making. Now, subsequent cases, of course, have almost, over the years, as the years have gone by, increasingly involved interpretation of the rewrite. And I'm not going to go through all of the things that have been said about the rewritten legislation and the approaches that have been adopted. For example, I'll just refer to one before I come on to look at NCL investments and the particular issue that arose there. And I've got another case and talk about before I get to NCL investments. In Fowler, for example, a case called Fowler versus Her Majesty's Revenue and Customs, which ultimately went to the Supreme Court. It dealt with provisions dealing with activities of divers and like who were nominally employees, but under statutory provision were treated as if they were taxed as if they were self-employed. And the question was how this interacted with a double tax treaty. And in the Court of Appeal, Lord Justice Lewison had this to say. He was, I think, in the minority in the Court of Appeal, even though the House of Lords, I think, came out more along his lines. But he said this: it's also pertinent to note that Section 15 was enacted as part of the so-called tax rewrite, whose purpose was not to change the law, but to recast it in modern and simpler language. Explanatory notes were provided to give the context and purpose of the legislation. As such, they are admissible aids to interpretation, although they cannot supplant the words of the Act itself. The general note to the 2005 Act explained that the purpose of the 2005 Act is to rewrite income tax legislation relating to trading, property, and investment income so as to make it clearer and easier to use. The Act does not generally change the underlying law when rewriting it. The only changes to the law which it does make are minor ones, which are within the remit of the tax law rewrite project and the parliamentary process for the Act. In the main, such changes are intended to clarify existing provisions, making them consistent or bring the law into line with well-established practice. And then he goes on to refer to the note dealing with the particular provision that he was looking at, section 15. The explanatory note says this section deals with activities which are strictly the duties of an employment, but which, if certain conditions are met, are taxed as if they were the carrying on of a trade. It's based on section 314 of the 1988 Act. Seems to me to be clear, particularly from the repetition of the point that the activities were to be taxed as if that they were carrying on a trade, that there was no intention to change the law. However, Mr. Schwartz is right. There's been a far-reaching and inadvertent change. So you can see there a judge whose predilection in that particular case, although not, I think, shared by his two fellow judges in the Court of Appeal, was to say, well, I can't construe this legislation. I have to find a way of construing this legislation so that it doesn't give rise to a far-reaching and inadvertent change in the law as compared to what it was before. But this has come up in the Supreme Court on a couple of occasions, the most recent NCL, which I'm going to get to in a minute or two. The first was a case called the Queen on the application of Derry versus Her Majesty's Revenue and Customs. I don't need to, I think, go into the detail of that case. It'll take a bit of time and it's rather complicated. But Lord Carnwath has a section of his judgment in which he talks about the statutory framework and the tax law rewrite project, which I won't read all of what he had to say, but fundamentally, as he notes at paragraph 9 of his judgment, in Eclipse Film Partners number 35 LLP, Sales J likened the correct approach to statutory interpretation to that appropriate to consolidation statute, as explained by the House of Lords in Farrell and Alexander. And then he quotes from this Justice Sales' judgment in Eclipse 35, which I've read out to you. And he says, I would respectively, this Lord Carnwath says, I would respectively endorse this guidance, which should be read with Lady Arden's comments on the relevance of prior case law. At the same time, I would emphasize that the task should be approached from the standpoint that the resulting statutes are intended to be relatively easy to use, not just by professionals, but also by the reasonably informed taxpayer, and that the signposts are there for a purpose, in particular, to give clear pointers to each stage of the taxpayer's journey to fiscal enlightenment. Now, Lady Arden disagreed with some of the conclusions of the majority in that case, but broadly speaking, she also has a section of her judgment in which she talks about the approach to interpretation of tax law rewrite statutes. And she says this, on issue 1, while agreeing with all that Lord Carnwath has said, I add some observations about the approach to the interpretation of the Income Tax Act and consolidation statutes in general to provide the context in which the passage from the judgment of Mr. Justice Sales, approved by this court, should be applied. And then she goes on, again, I won't read it all out. If you want to go away and read it yourself, it's paragraphs 84, 5, 6, 7, and 8 of her judgment. But she makes a good point at the end of her judgment, where she says, there is a further issue yet to be resolved as to the application of the doctrine of precedent, where there is a previous binding decision on the same provision in the earlier enactment. See the discussion in Benteen. Reference back to the earlier case law does not undo the good work done by the consolidation or run counter to it, since Parliament is likely to have had the previous case law in mind in any event when enacting the consolidating statute without any pre-consolidation amendment. So broadly speaking, she was saying, well, okay, you've got the consolidation Act. You approach that in the way that Justice Sales said, but that doesn't mean that you cut yourself adrift from the earlier case law, where the earlier case law can cast light on the meaning of the particular statutory provision. And that then is the background to the Supreme Court's decision last year in NCL Investments. I'm going to have to explain NCL Investments a little bit so that you can understand what was going on. NCL Investments was a subsidiary of a company called Smith & Williamson Holdings Limited. And it, along with another company subsidiary, Smith & Williams Corporate Services Limited, effectively employed people within the Smith & Williamson organization and then made their services available to other companies within the group. And those of you familiar with Smith & Williamson will know that they're in the sort of accounting and tax areas of work. And Smith & Williamson Holdings had set up an employee benefit trust in Jersey, and that trust, the trustees of that trust, granted options to employees as to incentivize them under a share option scheme, under which, when conditions were satisfied, they could then acquire shares in Smith & Williamson Holdings Limited. Now, the way in which the accounting for that worked will become apparent in a minute if I just refer to the judgment by Lord Hamlin and Lady Rose. And I'll just read the opening paragraphs because that sets the scene. This appeal concerns the proper treatment for corporation tax purposes of accounting debits which arose in the accounts of the respondent companies as a result of the grant to the company's employees of options to acquire shares in the ultimate holding company, Smith & Williamson Holdings Limited. The grants were made by the trustees of an employer benefit trust of which the holding company was a settlor. The companies were required by International Financial Reporting Standard 2, IFRS 2, to recognize in their profit and loss accounts that the services of their employees, who were remunerated in part by the options, had been consumed in generating their profits. The question that arises in this appeal is whether the consequential debits are to be taken into account in calculating the profits of the company's trades for corporation tax purposes in accordance with the Corporation Tax Act 2009. So that was the basic situation. And whenever the trustees granted options to employees of the companies effectively agreed to pay the holding company an amount equal to the fair value of the options granted for their respective employees. And that obligation was reflected in an intercompany balance owed by the companies to the holding company. And each month, the companies would settle the intercompany balance due, an arrangement which was known as the recharge. But broadly speaking, the way in which the accounting worked meant that there was charged in the profit and loss of the companies, the subsidiary companies, the fair value of the options, which reflected effectively the consumption of their employee services, as if they were paying their employees part of their salary through the grant of the options. And the balancing item, because in a double entry book system, you're always going to have something on the other side of a particular deduction, was in the balance sheet of the subsidiary companies. And so there was sort of a deduction in the profit and loss account, and the corresponding entry was in the balance sheet. Broadly speaking, it didn't matter whether the options were ever exercised or not. There was no adjustment for the deduction that had been taken in the profit and loss account. And of course, the company said, well, for corporation tax purposes, we compute our profits in accordance with accounting principles, and basically speaking, therefore, we're entitled to a deduction for these debits in our profit and loss account. and the fact that there's a sort of corresponding entry on the other side in the balance sheet doesn't affect that. Well, of course, the revenue didn't like that particularly. The idea that somehow you've got a deduction in your profit and loss account for, as they put it, something that money you never paid out. Anyway, to the extent there was any balance paid out on the other side, it was all on the balance sheet, not in the profit and loss account. So there was no adjustment in the profit and loss account. Now, one of the interesting features of this case is that the revenue lost at every stage. So they lost for the commissioners, they lost, the first tier tribunal, they lost in the upper tribunal, they lost in the Court of Appeal. And it's quite remarkable in many ways that they actually got permission to go to the Supreme Court. I'm sure a taxpayer who had lost at every stage to the Court of Appeal, even if they were minded to try and get to the Supreme Court, would have some difficulty in persuading the Supreme Court that actually this was a case that merited an appeal. Actually, in Eclipse, in Eclipse, they lost in the first tier tribunal, upper tribunal, and in the Court of Appeal, and they did apply to the Supreme Court. And the Supreme Court said that it would have a rolled up hearing for both the arguing the substance of the matter and the permission application. And broadly speaking, when we got to although we had to prepare all the papers for the Supreme Court, when we got to the Supreme Court heard submissions by counsel for Eclipse 35. They then said they only wanted to hear from me for 5 minutes, and then they refused permission. So there is no decision in the Supreme Court in Eclipse 35 because they just disposed of it by refusing permission, even though they'd had the benefit of all the papers by both sides arguing the issues. Now, there, of course, is a long history of cases which sort of say that profits for corporation tax purposes, as for income tax, trades and property businesses and so on, is computed in accordance with accounting principles. But some of the leading cases being Odeon Associated Theatres and Jones in 1971, but also was the case of William Grant Distillers in 2007. And in fact, I did a case for EDF Energy. It was actually under the name West Burton. It was all to do with deferred revenue expenditure, where I had occasion to argue many of the same issues on the accounting to the first tier tribunal based on the Court of Appeal's decision in NCL Investments. And I'm pleased to say the first tier tribunal found in West Burton's favour, and the revenue decided not to appeal the case further. Quite how they would have felt if NCL Investments had gone to the Supreme Court and it had been decided in favour of the revenue, I'm not sure. But as the Supreme Court said, Lord Hamlin and Lady Rose said, since we've come to the same conclusions as all the judges who've heard so far grappled with these issues, we do not need to set out their reasoning. It's also our reasoning and is set out below. So broadly speaking, the Supreme Court supported the decisions of the court and tribunal below that these were debits that were in the profit and loss account, and they refused to draw a distinction between the profit and loss account and the balance sheet. The point is made in paragraph 24, I think, is a decision where they said, although the revenue accepted IFRS 2 required the companies to recognise an expense in their income statements equal to the fair value of the options, they submit that the consequential debits are inapt to affect the trading profits of the companies for corporation tax purposes. If one has to regard to the archaeology of debits, they arise because the company's parent company established an employee benefit trust and the employee benefit trustee granted options to the company's employers. These transactions were treated by IFRS 2 as a capital contribution granted by the holding company to the subsidiaries. Debits did not represent any cost to the companies, nor did they anticipate or reflect an actual cost which would arise in the future. And the particular authority on which the revenue relied to support its proposition was a case called Lowry versus the Consolidated African Selection Trust Limited, decided by the House of Lords in 1940. And what had happened in Lowry, just to give that background, is that Lowry had issued shares to its employees effectively at par, even though they were worth a lot more than par. And the employees had been taxed in respect of the benefit they derived, being the difference between what they paid for the shares, the par value, and the market value of the shares at the time. That's just a standard tax schedule, employee taxation at the time under then Schedule E. A case called Waite and Salmon is authority for that. And what Lowry, sorry, not Lowry, he was a tax inspector. What the Consolidated African Selection Trust Limited said was, well, so hang on a second, if we had just paid our employees a bigger salary and they had required them to use that to buy the shares at their market value, we would have obviously got a deduction for the additional salary that we would have paid. So why can't we get a deduction for the amount that we've foregone by issuing shares at par rather than requiring employees to pay the full amount of the market value of the shares? And that was based on a case, a very early case, which was all to do with breweries and tied pubs, which I won't go into, is a very fascinating thing. If you want another case which deals with that and which relies upon Lowry, it's a case called Nash versus Tamplin and Sons Brewery, which was decided by the House of Lords in 1951. And some of that, the history, it's quite interesting to trace the history on some of that, because that's to do with the old system of taxation of property that we had, known as the Schedule A and the annual value of properties, which was the basis of charge up until 1963. Anyway, the case in Lowry illustrates the sort of divergence of judicial view on the matter that was argued in Lowry, because the commissioners, special commissioners in Lowry, decided for the taxpayer. In other words, they said you can deduct the amount foregone when you issued these shares at par. The High Court then decided the matter for the revenue, said no, you can't. The Court of Appeal decided the matter for the taxpayer, saying yes, you can. And the House of Lords, by 3-2 majority, said no, you can't. So that was one of those cases where there was significant divergence of judicial view about how it should be dealt with. But anyway, the revenue relied upon Lowry to say that the debit that was claimed in NCL was not actually money that had been incurred and therefore was available for deduction. And they actually run several arguments. Alternatively, they said, well, it's a capital item and therefore it can't be deducted because you can't deduct capital, even if nominally speaking, it is deducted in your, for accounting purposes, in your profit and loss account. And that link with capital is why I was concerned with the case in West Burton with deferred revenue expenditure, which the revenue was seeking to disallow as capital rather than a revenue deduction. I'll get on. You may wonder where I'm going to in relation to the tax law rewrite, but I'm almost getting there, you'll be pleased to know. So the submission by council for the revenue in NCL is summarised by the Supreme Court in this way. Mr. Ghosh submits that Lowry is authority for the following propositions. One, the issue of shares by a company does not affect the profits or gains of the company for tax purposes, and the words laid out or expended imposed a requirement additional to the words for the purposes of the trade, and the taxpayer company must suffer some cost or economic burden to its pecuniary detriment for an expense to be treated as laid out or expended. Now, laid out or expended was the old language of the Income and Corporation Taxes Act 1988. In fact, it was the language going right back probably to Peel's Act. I don't think it had changed, and Addington's Act as well. But that was historically the language that had been used. But the tax law rewrite had changed the language to incurred. Now, another case in which I was involved for the revenue was a case called Ingenious, and that was also a film scheme case. And I don't think I've got time to go through all the ins and outs of that particular case, but broadly speaking, it was a case where investors into the film scheme structure put up 30, and then it went through a mechanism which was designed to increase it up to 100, so that broadly speaking, the relief was given for 100, which effectively gave you the investors a tax repayment of their 30, so that actually they had a zero cost for their investment. And then broadly speaking, they hoped they would derive income from the films. Broadly speaking, they did derive income from the films, but they were never going to make a profit because the amount of income they derived from the films was never going to repay the 100 that theoretically this structure said that they had put up. And one of the arguments was that the only amount that they had incurred was 30, because that was the only amount that money that they'd actually stumped up and had to suffer the cost of. And in the upper tribunal, I've been successful in persuading Mrs. Justice Falk, as she then was, that actually that was what incurred meant under these provisions, although there is a twist to that. And so the revenue were relying on that in NCL investments. Now, when we get on to what the Supreme Court says about this change in language, they supported the view of the commissioners. I'll just read what Lord Hamblin and Lady Rose wrote in their judgment. They said, "We agree with the conclusion of the first tier tribunal that when Parliament uses the word incurred, it does so simply as a participle that takes its colour from the word expenses and does not intend to impose a freestanding requirement to be applied to accounting debits. We do not consider that Lowry assists. That was dealing with a different statutory regime, and as the first tier tribunal observed, one which did not accord the accounting measure of profit, the status that sections 46 and 48 of the 2009 Corporation Tax Act confer. It was also not dealing with an expense which was required to be brought into account as a debit in accordance with generally accepted accounting principles. To the extent that the upper tribunal indicated a contrary view, obiter in the passages relied upon in ingenious gains, it was wrong to do so." In their written submissions, the revenue sought to justify their reliance on Lowry in support of their construction of Section 54 because they said the replacement of the words laid out or expended in the Income Tax Act 1918 with the word incurred in Section 54(1)(a) was not intended to effect a change in the law, so that the same analysis should apply. They submitted that this approach was consistent with the approach to construction of the tax law rewrite project statutes including the Corporation Tax Act 2009. They cited in particular the approach to rewrite case law set out by Lady Arden JSC in Derry. Mr. Ghosh also referred to this in his oral submissions. Lady Arden, in her judgment, concurring with the judgment of Lord Carnwath, made some observations about the approach to the interpretation of rewrite legislation, in that case, the Income Tax Act 2007, and to consolidation statutes more generally. Lord Carnwath set out a passage from Eclipse 35, which had likened the correct approach to the interpretation of tax law rewrite legislation to that appropriate to a consolidation statute, as explained by the House of Lords in Farrell and Alexander. That emphasised that a consolidating statute should be construed as a single integrated body of law without the need to refer back to the same provisions as they appeared in earlier legislative versions. And it goes on about what Justice Sales and Lord Carnwath said. And then 46 of the Supreme Court decision in NCL, it said this: at paragraph 88 of her judgment, Lady Arden expressed the view that the restraint required by the House of Lords in Farrell and Alexander related to referring back to legislative history, but not to relevant antecedent case law. Reference back to earlier case law did not, Lady Arden said, undo the good work done by the consolidation or run counter to it. Lady Arden's comments were not necessary for determination of the appeal in Derry, and the effect of Farrell and Alexander regarding reference to the consolidation was not the subject of any written or oral submissions in Derry. It's not necessary in the present appeal to consider whether what was said in Derry is consistent with what was said about consolidation statutes in Farrell and Alexander, nor how that would apply to a tax law rewrite project statute. In the present case, the use of the word incurred is different from the earlier wording considered in Lowry. It is a plain English word that is unambiguous and can be construed satisfactorily in its context without the need to consider any glosses or baggage that might have attached itself to the earlier pre-write provisions. However, given the prominence with which the comments of Lord Carnwath and Lady Arden in Derry were given in parts of the revenue submissions, we think we should sound a note of caution that in a future case it may be necessary to give further consideration, with the benefit of submissions on the issue, as to whether and when it's appropriate to refer to earlier case law, either in relation to a consolidation statute properly so called, or to a tax law rewrite project statute. Well, of course, that is potentially quite a radical suggestion if underlying that is a sort of suggestion that actually there are cases where you're not going to refer back to earlier case law, particularly in the case of the tax law rewrite project, given the history of the taxing statutes leading up to what was done under the tax law rewrite project. And I must say, I find that a very odd comment for the Supreme Court to have made. No doubt they may have wanted to make a point, but it's not a point which actually stands very well in light of the issues that they were considering in NCL investments. And I say that for a number of reasons. The first reason, of course, is that certainly as a member of the consultative committee, I think I can say with some confidence that nobody believed that changing from laid out and expended to incurred was doing anything other than using a more familiar English word, incurred, that had exactly the same meaning as laid out or expended. The idea that in some way there might be a difference between laid out and expended under the old law and incurred under the new seems to me to be entirely fanciful. It may be that Lady Rose was not suggesting that there should be, but it sounds a little bit from what she writes as if that might have at least been a thought underlying what she wrote in paragraph 47. And it was of particular relevance to Ingenious, because actually Ingenious, the years in issue in Ingenious games, actually spanned the period of the rewrite. So the earlier periods were pre-2005, where the language laid out and expended was used, and post-2005, when the word incurred was used. Nobody in Ingenious suggested that in 2005, somehow by changing the language from laid out and expended to incurred, that any particular change in the law had resulted as a result of that change in language. And it would have been, in my view, fanciful to have started arguing in Ingenious, whether for the revenue or for the taxpayer, that there might be some difference in meaning between the two, between those years, according to whether or not it referred to laid out or expended and incurred. And the second point is there's no real need to suggest that there was any change in language, because of course what had changed is the way in which accounting principles applied to determine profits. If you say, as the House of Lords says in Lowry, there was no evidence that accounting required a company that issued its shares to employees at par to bring into its profit and loss account a deduction for the undervalue, the amount foregone by issuing shares on that basis. There was no accounting evidence. There was, of course, significant development after Lowry, both in terms of the case law, if you think of Odeon Associated in Theatres and Jones, and the William Grant case, and all the other Gallagher and Jones, and all the other cases that followed. There was, of course, developments which Section 46 of the Corporation Tax Act 2009 was effectively the statutory enactment of, based on the changes that had been made in 1998. So there really was no need to say anything other than something along the lines, well, statutes are always speaking. So broadly speaking, if there's a development in the way in which accounting allows you to compute your profits, as between how it stood in 1941 or 1940, I think, when Lowry was decided, and now, that's a perfect explanation. So it's not that the reliance on Lowry was inappropriate. It's just that Lowry had been overtaken by events, not overtaken by the tax law rewrite, but overtaken by the developments in accounting and the subsequent authorities that had engendered as to how you computed profits. So although there is a suggestion here in NCL Investments that maybe there is some issue to be resolved about how far you can look back in determining whether a previous authority is relevant in construing the tax law rewrite, I don't think NCL Investments was the right case in which to be making that point. And for my own part, I think it's very difficult to understand a great deal of the Tax Law Rewrites Acts without having regard to earlier authorities under the old statutes, even if you are approaching the tax law rewrite in the way that Justice Sales suggested in Eclipse 35, and which the Supreme Court endorsed in Derry, treating it as a consolidation or similar to a consolidation act. One starts with the language of the act, but to the extent that the language of the act has some degree of ambiguity or requires some greater understanding to be able to arrive at a conclusion as to what it really means, then why shouldn't you look back to early authority? Certainly, I would be regretful of the idea that one had to start with the rewrite and effectively develop 200 years of judicial consideration of the rewrite acts to work out what it means without any reference back to earlier authority. Anyway, so that was, broadly speaking, what I wanted to say by reference to NCL Investments. I'm sure you will be very good haven't seen anybody fall asleep, but so that's excellent. Well, I think it was, I can't remember, Robert Sheldon, I think, who in Parliament, I think it was probably a finance bill debate, one of his colleagues stood up and drew attention to the fact that Robert Sheldon had seemed to have fallen asleep during the course of the debate, to which, I think it was Robert Sheldon, anyway, to which he jumped up and said that my learned friend has no more right to assume that I'm asleep because I've got my eyes closed than we can assume that he's awake because he's got his eyes open. Anyway, I think I should stop at that point. Thank you.
Thank you very much for that enlightening and fascinating presentation with the advantage of a first-hand experience on the rewrite committee. I don't know if there are any questions people want to pose at this point. I think there'll be the opportunity, I hope, perhaps also informally, but is there any question anyone wants to pose at this point about the tax law rewrite in general? Please, Joy.
Can I pose an easy one? With the benefit of hindsight, would it have been better to have rewritten the law? Involving the amount of people and effort that went into the rewrite.
That's quite difficult. When you say you mean, in other words, to do a sort of more fundamental job of actually trying to, I mean, I think the basic problem would have remained the one that the TLRC drew attention to in its report on the procedure, that you're then into the whole process of having to take it through Parliament. And of course, as a sort of project to do that across the whole of income tax would have been impossible. I mean, I think the sort of the criticism, or I think the observation I would make is that, of course, since we had the rewrite, we have had vast amounts of legislation. I mean, I remember John Kay, when he was director of the IFS, I think it was in 1986, in his valedictory lecture when he left the IFS, having been director for about 5 or 6 years or whatever. And he drew attention to the fact that I think it was the 1986 Finance Act. It was the longest Finance Act ever. And broadly speaking, much to the chagrin of the revenue officials who were sitting next to me as they listened to this lecture, he said this act achieved absolutely nothing. And broadly speaking, what he was saying was a disgrace that we had 250 pages of legislation that did absolutely nothing to improve the tax system at all, that this was just a sort of process that we seemed to be unable to get out of. Well, of course, if we had a finance bill of 250 pages, in a sort of regular year, we'd think that was great. At that stage, the 1986 Act was, I think, the longest Finance Act ever, other than possibly the 1965 Act. But broadly speaking, in the years that followed, and that have followed, I mean, we've got used to huge finance bills. And the problem essentially is that we're still stuck in this process of having to tinker with the system, sort of to adjust it in this way and that, without necessarily at any particular stage having a clear view as to what the long-term objective is in terms of the tax system we want to create. That would be my sort of overall observation. So I don't think we necessarily would have needed a project like the tax law rewrite project in the form of a tax reconstruction project. You just need to have a clear view of the direction in which you want to take the tax system and approach it methodically over a number of years. But unfortunately, that doesn't necessarily seem to happen for a whole variety of reasons.